Michael Saylor's strategy just sold 3,588 Bitcoin for approximately $216 million. And this is one of those news stories that looks small at first, but becomes much more important when you understand what is happening behind the headline. Because yes, Strategy still holds a massive Bitcoin position. After this sale, the company still owns 843,775 Bitcoin. So if you only look at the percentage, some people will say, why is everyone worried? They sold only a small part of their Bitcoin. This is not a big deal. And on the surface, that sounds reasonable. But in my opinion, the market is not reacting only to the number. The market is reacting to the change in direction. For years, the Strategy story was extremely simple. Michael Saylor buys Bitcoin. Strategy keeps buying Bitcoin. They hold Bitcoin. They do not sell Bitcoin. And over time, the company increases the amount of BTC on its balance sheet. That was the entire narrative. That is why a lot of investors looked at MSTR not just as a normal stock, but almost like a leveraged Bitcoin vehicle. People believed that buying Strategy shares gave them exposure to a company that was aggressively accumulating Bitcoin and treating it as a long-term treasury asset. But now, the narrative is becoming more complicated. According to the filing, Strategy sold 3,588 BTC, and the proceeds will be used to fund distributions on its preferred stock and to replenish its US dollar reserve used for those payments. And this detail is extremely important. They did not sell Bitcoin to buy more Bitcoin. They did not sell Bitcoin to launch a new product. They did not sell Bitcoin because they found a better opportunity. They sold Bitcoin to support the financial structure around the company. That means Bitcoin is no longer only being treated as a long-term asset on the balance sheet. It is also becoming a source of liquidity. And that changes the way investors look at the company. Because now the question is not only how much Bitcoin does Strategy still hold, the real question is, what happens if the company needs more cash again? What happens if preferred stock distributions continue? What happens if the market becomes weaker? What happens if Bitcoin price goes down and the company still needs to maintain its dollar reserve? Will Strategy sell more Bitcoin? That is the uncomfortable question. And this is why the first big sale matters. One sale can be explained as capital management, but if we start seeing repeated sales, the market may start treating this as a pattern. And when a pattern appears, the narrative changes. Before, Michael Saylor was seen as the buyer of last resort. The guy who buys Bitcoin when others are afraid. The guy who keeps adding BTC to the corporate balance sheet. But now, the market has to consider a new possibility. Under certain conditions, Strategy may become a seller, and that is a completely different psychology. Another detail is also important. The Bitcoin was sold at an average price of around $60,000 per BTC, while Strategy's average purchase price is reported to be around $75,476 per Bitcoin. So this does not perfectly fit the old never sell, only accumulate story. And again, I am not saying this is the end of Strategy. I'm not saying this means the company is collapsing, but I do think this is a serious signal. Because the market is starting to ask deeper questions, not just who holds Bitcoin, but how is the entire structure built? Where does liquidity come from? What obligations exist around the asset? And can the company keep its strategy if market conditions become worse? That is the real story here. The headline is, Strategy sold 3,588 Bitcoin. But the deeper story is, the market may be repricing the Strategy narrative. And once investors start asking whether Strategy is still only a Bitcoin accumulator, or whether it may also need to sell BTC to support its financial structure, the whole perception around the company can change. That is why this news matters. And this brings me to a much bigger point about the crypto market. Because this Strategy news is not only about Michael Saylor, it is also about how investors should think about financial structures in crypto. A lot of people focus only on the asset. They ask, should I buy Bitcoin? Should I buy Ethereum? Which coin can go up? But I think the more important question is becoming, how does the structure actually work? Because even if the asset is strong, the structure around it can create pressure. Strategy may believe in Bitcoin long-term, but if the company has financial obligations, preferred stock distributions, dollar reserve requirements, and market pressure, then Bitcoin can become a tool for liquidity. That is the lesson. And this is exactly why I think more investors are starting to look at alternative DeFi models. Not just pure speculation, not just buying a volatile asset and hoping the price goes up, but structured models where the mechanics are more clear, where users can look at the terms, where the platform explains how liquidity is routed, where the strategy is not only based on price appreciation. And this is why I have been watching projects like AurumFi. AurumFi is a DeFi platform built around USDT and gold-linked liquidity strategies. The idea is not simply buy a token and wait for it to pump. The idea is more structured. Users can deposit USDT, choose fixed-term access, and the platform routes liquidity into strategies connected to tokenized gold liquidity. So instead of only relying on the price of Bitcoin or another volatile crypto asset, AurumFi is trying to build a model around gold-linked liquidity, automated distribution, and defined terms. And I think this narrative is becoming more relevant right now, because when even one of the biggest Bitcoin treasury companies starts selling BTC to support its capital structure, investors begin to understand something important. It is not enough to know what asset is inside the system. You need to understand how the system itself works. What is the liquidity model? What are the terms? What is the source of yield? How are distributions handled? What risks exist? That is the level of thinking that serious crypto investors need. Now, to be clear, this is not financial advice. AurumFi is still DeFi, and DeFi always carries risk. There can be smart contract risk, liquidity risk, platform risk, and market risk. So you should always do your own research before using any DeFi platform. But what I find interesting about AurumFi is the positioning. It is not trying to be just another meme coin. It is not just another buy and hope crypto play. It is focused on structured DeFi, USDT, fixed-term access, and gold-linked liquidity. And in the current market environment, I think that kind of model will attract more attention. Because the market is becoming more selective, people do not just want hype. They want to understand the mechanics. They want to know where liquidity goes. They want to see a clearer structure. And that is why AurumFi fits into the conversation. On one side, we have Strategy, a massive Bitcoin holder, selling BTC to support distributions and reserves. On the other side, we have new DeFi platforms trying to build alternative liquidity models around assets like tokenized gold. That contrast is important. It shows where the market may be going next, not only toward holding crypto assets, but toward understanding the financial structures behind them. So if you are watching this market, I think this is the main takeaway. Do not only look at the headline. Do not only look at who holds Bitcoin. Look at the structure. Look at the liquidity. Look at the obligations. Look at the model. Because in crypto, the structure can be just as important as the asset itself. And if you want to check out AurumFi, I will leave the link in the description. Study the platform, look at how it works, understand the risks, and make your own decision. But personally, I think projects like this become more interesting in a market where investors are starting to ask better questions. Not just, what can pump? But, what structure actually makes sense?